So today in our review session, we're going to be looking at the Chapter 13 problem. Keep in mind that the numbers that you see in this recording in this problem may be different than the numbers in your actual problem, but the steps that we go through, the calculations we do, would be done in the same way, but you just would need to use the same number, the numbers that match up with your problem if they are different. So what we have is a company, Championship Boxing Incorporated, and we are given their cash flow statement. So we can see the actual cash flow statement. We're not going to be constructing that, but as we frequently do with these mastery problems, we're going to be working backward. So we have the cash flow statement, and from that, we're asked to fill in the information that would have appeared on their balance sheet. This is the reverse order that things would typically happen. If we were actually this company, we would have their balance sheet as well as some other information, including their income statement, and we would construct the cash flow statement. But we are going to reconstruct the balance sheet from the cash flow statement. Okay. And only the balance sheet. So we're not going to be looking at the income statement. So some of the information on the cash flow statement comes from the income statement, as you know, and some of it comes from the balance sheet and some from stockholders' equity. So we're only interested in the parts that relate to the balance sheet. So we have our balance sheet, and maybe the best way to approach this is to just start with the end in mind, start with what is it we're looking for the balance sheet. And so we'll just start with the first line, cash, and we are given the balance from the end of last year, and our job is to determine what the balance from the end of this year would be. And we can see right here, it's even on the screen for us, that the reconciliation at the end of the cash flow statement always includes both the beginning and the ending balance from the balance sheet, in cash. And the purpose or the function of the cash flow statement is to explain why did our cash go from, in this case, $586,000 up to $609,000. That was an increase in cash of $23,000. Where did that come from? And you can see here the totals that went into that. The net cash flows from operating, from investing, and from financing activities. So adding those three numbers together gives us this 23,000 and change, I'm rounding, increase in cash. So again, we can see the number that we need right there just to finish the first line of the balance sheet. Now we move ahead to the accounts receivable, and we're given the ending balance, and we have to find the beginning balance. So what does it tell us about accounts receivable? There was an increase in accounts receivable during the year. That increase was $25,410. So in order to get back to the beginning of the year balance, if we know it went up during the year, what are we going to do to get back to the beginning? We're going to subtract that increase of $25,410. Again, using the numbers that are in my problem. If you are here live and you have questions on anything we're talking about, of course, just please break in and let me know. Otherwise, I'll just keep going. So the next line in the balance sheet is the inventories. And we are told that the beginning balance in inventories was $618,420, but that our inventories went up during the year by $33,350.
I did the exact same thing you did for the previous one, and it didn't work. I got the same numbers and everything, and still didn't. I don't think I did it wrong in the calculator either.
Okay, give me 1 second. Okay, I paused the recording there for a moment because it was brought to my attention that I had a math error. I just punched it into my calculator wrong. I had put in 203 rather than 230. And so the correct beginning balance for accounts receivable using these numbers should be 205,560. So thank you for bringing that to my attention before we got all the way through. And now let's go on to the inventories. So we had a beginning balance of 618,420 in inventories. And then that's one of the adjustments from the income statement in the operating section. So we were told that we had an increase in inventories. So that means we need to add that increase to the beginning balance, $33,350, to find our ending balance of $651,770. Okay. So what else happened? Well, the next line is our investments. And we can see that we have no investments at the end of the year. And here in the investing section, we can see we received cash from the sale of the investments of $280,000. What else do we know about the investments? So it says they were sold for $280,000 in cash. But we can see here that we had a gain on the sale of those investments of $50,000. What that means is we sold the investments for $50,000 more than we were carrying them on our balance sheet. So if we sold them for $280,000, but we made $50,000 on that sale, that means the original or historical price of those investments must have been $230,000. Since we have an ending balance of 0 there, we know that the $230,000 must have been the beginning balance. Next, we have the land account. And you can see that at the beginning of the year, we had 0 in our land account. And right here, it tells us that we paid cash to purchase the land for $326,000. And up here, it confirms that that was the full price. So it doesn't say anything about we issued a mortgage or a note payable or anything. This wasn't a down payment. That was the full value of the land, $326,000. So again, since we had 0 at the beginning of the year, and we just bought $326,000 worth of land, that must be our ending balance. What about equipment? It tells us that we paid cash for equipment for $152,000. And up here, it tells us there were no disposals of equipment during the year. So the only change to the equipment account is that we bought $152,000 more in equipment. So if the equipment had an ending balance of $705,200, and we know that includes the $152,000 worth of equipment we bought during the year and nothing else changed there, our beginning balance must have been $553,200. That's the ending balance minus the $152,000 that we bought during the year. Now, when you think about the adjustments that come in the operating section from the income statement, we know that new depreciation expense is one of those adjustments. And we can see here that from the income statement, we recorded $18,400 worth of depreciation expense during the year. We know from that guidance for operating cash flows, that page that we have in Blackboard, we know that that depreciation expense reduced our net income, but did not affect our cash, and so we have to add it back. So when we look at the accumulated depreciation account, we know that the only thing that happened in that account this year is that we added $18,400 worth of new depreciation. So to get back to the beginning balance, we have to subtract that $18,400. And I'm showing that as a negative because accumulated depreciation is a contra asset, it offsets or reduces our total assets. So I'm sure that on your own, you can go ahead and total up the assets for each of those 2 years. Unless you have questions on that, I will just keep going to keep this as simple and self-directed as possible. So let's go on to the accounts payable. So at the beginning of the year, we owed our creditors $391,800. Accounts payable is a current or operating account. And so let's take a look in the adjustments in the operating section. We can see that we had an increase in accounts payable of $41,100. So since we have the beginning balance of $391,800, and we know there was an increase, we just need to add that increase to get the ending balance. So it was $41,100 in addition to what we already owed at the beginning of the year. Now for our accrued expenses, and it tells us these were operating expenses, that tells us that any change in those is going to be included here in the operating activities section of the cash flow statement. And you can see that during the year we had a decrease in those accrued expenses of $12,470. So we have the ending balance here. If there was a decrease during the year, then the beginning balance must have been higher. We need to add the $12,470 to the ending balance to find that beginning balance. And finally, in the liability section, we have dividends payable. So what do we know about dividends? Well, we paid cash of $91,200 for dividends. And here we are told that there was a $96,000 debit to retained earnings for cash dividends declared. So they declared, this one is a little bit more involved, so it might be easiest to see this if we put a T account here on the screen to figure this one out. Okay, because there's two different pieces of information we have to take into account here. So let's look at our dividends payable. So what do we know about dividends payable? It started with a balance of $19,200. That, of course, would be a credit balance because dividends payable is a liability. We start with the $19,200. Then we're told there was a $96,000 debit to retained earnings. The credit side of that would have been to dividends payable. Okay. What else do we know? We see right here in the financing section that the cash we paid for dividends was $91,200. So that entry, remember the reason that there's a difference here between the cash we paid and the change to dividends payable is because of the difference. Remember from chapter 12, the 3 important dates as it relates to dividends. There's the declaration date. On the declaration date, we credited $96,000 to dividends payable. Then there's the date of record when there's no accounting entry. And finally, there's the payment date. And we're told that on the payment, on those payment dates, we had paid a total of $91,200. So for our balance sheet, we need to find the ending balance. It's this number right here that we're trying to find, the ending balance for dividends payable. So now we can see those 2 different transactions that affected that account. making this one a little bit more involved than all the other entries that we've done so far, where it was just one item that happened, or one entry, one calculation to make. And so if the beginning balance in dividends payable was $19,200, we declared $96,000 in dividends and paid $91,000, then the ending balance must have been $24,000. Be good with that?
Yep.
Alrighty. Then it tells us that 12,500 shares of common stock were sold for cash during the year. So that's a financing activity. And we can see right here that we sold that stock for a total of 187,500. Again, thinking back to what we learned in chapter 12, when we sell stock, and it has a par value, which this does. We're told it has a $4 par value. We put the par value for those newly issued shares into the common stock account. So 12,500 shares at $4 per share, 12,500 shares at $4 per share is an increase of 50,000 to the common stock account. So it had 100,000 in there at the beginning of the year. It would now have 150,000. We sold it for a total of 187,500. So of that 187,500, the first 50,000 was for the par value, and the remaining 137,500 would be paid in capital in excess of par, or additional paid in capital. So we need to add that 137,500 to the beginning $280,000 balance to find the ending balance. So again, what goes into the additional paid in capital account is the sale price over and above the par value, just like we learned in chapter 12. So we don't yet know either of the balances in retained earnings. There's a couple different ways we can go about this. One is we could find the difference in retained earnings by taking into account the net income that we earned and then the dividends that were declared. But I think the easiest way for us to go about this is to actually go back and do the totals on the assets, which I had said without looking ahead, I had thought we wouldn't need to do those together, but let's go ahead and do that now. We need those totals in order to finish up the exercise. And so if I added correctly, our total assets at the end of the year were 2,356,570. Checking my math here. So we know if that's the total assets, that also must be what other number on the balance sheet? It must be the total liabilities plus equity. Right? So we know that the total liabilities, we know the total stockholders' equity. We can then figure out how much the balance in retained earnings must be so that these three pieces of equity, the par value, the additional paid in capital, and the retained earnings need to equal this total. So if we take that total and subtract the common stock and the additional paid in capital. That will give us the retained earnings at the end of the year. Now, as I was saying, once we have that retained earnings from the end of the year, there's a couple other things we can do to find the beginning balance. One, we can do similar to what we just did. We can find these other numbers. So total liabilities is what I'm doing right now. And our total assets. And then we know that that total assets number needs to be the same as the total liabilities plus equity. We can subtract the liabilities from that to get the total equity. And then do exactly what we did for the end of the year. Subtract from that the two equity accounts that we know to find the one that we do not know. But the other thing we could have done, since we know the retained earnings at the end of the year, we could have subtracted the net income and then added back the dividends, and that would give us the same number if I've done all of my math correctly. So if
Yeah, we're good.
So if I had taken the 1,291,020, subtract the income, add back the dividends, we'd get the same result. And that is the Chapter 13 problem.